Welcome to another Mr. James accounting tutorial. This time we are looking at accounting unit 1 of KEEP, and I'll be doing the entire series of past paper from 2013 right down to 2019, and there was no paper in 2020. So the first question, part E, outline the structure of the conceptual framework of accounting. You may use a diagram for 6 marks. Okay, I've prepared the following diagram. It shows the three different levels of the conceptual framework. First level is the objectives of financial reporting here, and this shows the why, the goals and purposes of accounting. The next level, the second level, this bridges the between level 1 and level 3 here, and it gives you on one side the qualitative characteristics of accounting information, and on the other side the elements of financial statements. And at the third level we have the operating guidelines. It give us the recognition and measurement concepts, and that is supported by the assumptions, principles, and constraints. An alternative to this answer was to list out the three sections of the CFA and list the items that I had just spoken about. Part B, state three reasons why the conceptual framework of accounting was developed by the International Accounting Standards Board, IASB, for 3 marks. Now these uh, uh, now you are just expected to state three reasons. No explanation or anything is required, and 3 marks. Okay, I've given you here 6 reasons. You can state any three. Allow for consistency in the preparation of financial statements. Secondly, provide a basis for resolving accounting and reporting problems. Third, provide a basis for setting new accounting standards. 4. Allow comparison of financial reports. 5. It acts as a set of guidelines for preparation of financial statements. And finally, 6. It helps to reduce errors in financial statements. Part C required us to outline in your own words the meaning of any three of the following qualitative characteristics of accounting information: relevance, reliability, comparability, consistency, and understandability, for 6 marks. So it's 2 marks for one, so they are not really looking for any long answer. Okay, I have given you enough for each one. 5 there, you only required 3. Relevant. Accounting information is relevant when it is useful in decision making. It should have predictive or feedback value and be timely. Now, when you writing out answers like these, what they would be looking for is keywords. To get to get the mark, you should have useful in decision making, predictive or feedback value, and it must be timely. Okay. Reliability means the information can be verified. It also means it has a faithful representation of the facts and is reasonably free from error and bias. Okay. Again, the keywords would be verified, faithful representation, free from error and bias. Comparability means the information can be compared to that of similar organizations which use the same accounting principles. Okay, so the keywords would be similar organizations using the same accounting principles. Consistency means the information was produced by applying the same accounting treatment to similar items from period to period. Okay, so the same accounting treatment period to period. Understanding means accounting information can be understood by those who have a certain level of knowledge and education about business. Okay, by those who have a certain level of knowledge and education about business. That's the key part of it. All right, and not that everybody, the man in the street and so on, would be able to understand it. No, those who have some accounting knowledge or knowledge about business who will be able to understand it. D. State four steps that lead to the establishment and issuance of an accounting standard for 4 marks. The issuance of an accounting standard, it must pass through what is called due process. In the ISB has 6 steps in the due process, and you ask for 4 steps here, so you can name any 4. Okay, what I've done here is divide up the 6 into 4 steps, and given you it here. A problem is identified by any relevant party when and tabled the ISB setting up a steering committee or task force to study the issue. So first, a problem is identified by any relevant party, and when tabled, the IASB sets up a steering committee or task force to study the issue. Secondly, the steering committee prepares an exposure draft into taking into consideration national and regional requirements and practices. Thirdly, the exposure draft is sent out for discussion and public comment. And fourthly, after comments are analyzed and revisions made, the exposure draft becomes a standard and is released. Part E, state 4 ways in which internal controls can be achieved in an organization to enhance the accuracy and reliability of accounting records. 4 marks. Okay, they ask for 4 ways. I've given you 1, 2, 3, 4, 5, 6, 7, and you can give any 4 of 7. Ensure proper documentation of transaction. Ensure that one individual is not responsible for both the records of an asset as well as the custody of the same asset. So you want to separate the functions of recording and custody for the same asset. All right? Ensure that internal audits are done on a regular basis. When recruiting new employees, especially those who will be concerned with the accounting records, you make sure they are competent. Ensure key personnel internally verifies the work of others, such as cashiers, receivables, and payables clerk. Enforce the use of proper authorization for transaction and ensure that related duties are segregated. This one was probably mentioned up here already. Okay, so there you have it. Okay, right? They are looking for enhancing the accuracy and reliability of accounting record. Okay. The new accountant clerk at DG Limited had difficulty in making the required journal entries in the following situations. DNG Limited purchased a welding plant from Welders International for 150,000 on 15th of March 2012. On that date, a payment for 100,000 was made and the balance was scheduled to be paid no later than 2 months after. Okay, so we had to prepare journal entries necessary with narratives. Calculations must be clearly shown. 12 marks. There aren't really any calculations to do. Okay, so the first one, the journal entry would be debit equipment. We bought equipment for 150,000 on the 15th of March, and we are going to credit cash because we paid cash 100,000, and we remaining 50,000 would be owed to Welders International. Okay, the narrative being purchase of a fixed asset by partial cash, partial credit. Okay, the next item is on April 30th, the balance owing on the welding of the plant was paid. So this 50,000 here was paid. Okay, the journal entry for that would be debit welders here to clear this and that would clear off, and we have a credit for cash paying and to record payment of outstanding balance on equipment. The next part asks for office supplies worth 25,000 were purchased during the year. After the annual stock taking exercise at the end of the year, office supplies on hand had a value of 2,500. The adjusting entry for the supplies used needs to be made. Prepare the journal entry again with narratives, and they are asking for the adjusting entry, not for the 25,000. Okay, right. Two situations could be possible here. One is where you put the original 25,000 into an asset account called office supplies prepaid. Okay, in that case, you would want to transfer to the expense account 22,500 and leave the 2,500 remaining in the office supplies prepaid account. Okay, and we'll credit office supplies with 22,500 to do that, and debit office supplies expense at 22,500. The other scenario is where uh, the expense account may have been debited with 25,000 when you purchased during the year, and what you would have to do with that is take 2,500 out of the expense account by crediting it with 2,500 and putting it in office supplies stock here. And the narrative would be the same to account for office supplies used during the year. And that would bring us to the end of that part of the question. If you find this video helpful, you can leave a comment in the box underneath. Let me know if you wish to have other topics or other past papers rather solved. Subscribe, like, comment. We have before us trial balance. The unadjusted trial balance was taken from the books of Keymark Limited, a medium-sized store located in downtown Montego Bay. Notice the three lines for the headings. Before you jump into what is required, you should look at the time trial balance carefully. Make sure that it is balanced and the items are in the correct columns. Sometimes the examiner likes to put them in the wrong column and then expect you to correct it before you give the answer. Now, what is noticeable about this and what is concerned about us? We have three items here. First, we have this thing called organization course here that most Unit 1 students have never come across yet. They refer to startup course, and the normal accounting treatment for them is to transfer it to the profit and loss account. Uh, there are two ways of transferring it to the profit and loss account. You can either do so the whole amount, transfer it in the first year, or you transfer it bit by bit every year. And we are not given any instructions as to what to do with it. So what we will do is transfer the whole balance to the profit and loss account in this our year here. The next item is the note payable. You notice we do not have a percentage given here, and none is given either in the additional note, so you don't know what to do with it, whether to calculate interest, how much interest, or whatever. And the final item is freight in a name for an account that most CSEC students or POE would come across as carriage inwards. Okay. First, we read what is required of. A multiple step income statement of comprehensive income in good form, vertical, according to IAS 1, Section 3 of IFRS for SMEs, and Part 2, a statement of retained earnings. Okay, now we can go through the additional notes and we have to make these adjustments to the accounts or to the trial balance before we can write up the income statement. Now, We have to do the workings first before we jump into the and writing out the answer. If we do not do the workings first, we start writing up the answer, we are going to write up an incorrect answer. There's no doubt about that. So it doesn't matter if you spend about 15-20 minutes writing up the workings and doing the workings. Writing up the answer after that is going to take you less than the other 25 minutes or so that you have. Okay? In fact, you might be able to finish it in less than 10 minutes. So the first item we have here is the merchandise inventory, and we don't have to do any workings on that. The figure is given to us. Next, we have the depreciation on the equipment is charged at a rate of 10% on cost. So we had up workings on our page, and depreciation, the cost of the thing from the trial balance is 170 to 40, and it's 10% on cost, so it's just 10% by the cost. I will get 17,024. Next, we have the insurance expired during the year amounted to 1320. So that is going to be the amount for insurance. Normally we transfer the expired portion to the profit and loss account. It was discovered at the end of year two, at the end of the year, that a total of 50,000 of the accounts receivable was uncollectible. Uncollectible is the American terminology for bad debt, sometimes used in the international scene as well. Okay, so 50,000 is bad, and you gotta write it off as bad. So bad debt 50,000. We are not going to do the balance sheet section, so we don't need to minus it from accounts receivable. All they ask us for is a statement of comprehensive income. Okay, bad debt expense, and this here is another error again. It should be provision for bad debts is estimated at 2% of accounts receivable. Okay, so provision for bad debts would be 2% of the account receivable in the trial balance is given as 300,050, and that would be equal to 6,001. We want to bring our bad debts provision up to this amount. So we already have 4,482 in the trial balance. So we need to put in only 1519. So our increase in provision for bad debts would be 1519. Correct. And here's one of those items that something the percentage is missing, so we cannot calculate the interest on the note payable that is due during the year. This note is more pertinent to the balance sheet. Corporation tax is to be charged at 3.3%. Okay, when we calculate the profit, we will work out to the 3.3% as tax. The bond payable attract an interest of 10% per annum, and it's paid semi-annually. What you need for your income statement is 1 year's charge. So we have the corporation tax will be calculated when you have calculated the profit. Okay, so the bond payable attract an interest rate of 10% per annum. Bond interest equal 102,600 from the trial balance multiplied by 10%. What you want is 1 year's charge in the income statement. Then we have the dividends. The preferred dividend is 8% by 120,000, and that is equal to 9,600. Ordinary dividend, we have some workings to do. Take the amount in the trial balance and divide it by the amount per share, $20. We'll get 15,000 shares. It's $2 per share. So 15,000 by 2 gives us $30,000 ordinary dividend. And we have completed all our workings there. So coming up next, preparing the income statement. We begin to write up our income statement, and we begin with the sales, and from that we will list the sales, returns, and allowances. At CSEC level, we know this as sales returns, but if you're doing an income statement according to the IAS, you need to take off all the allowances as well. Allowances are for bad debt, provision for bad debts, and then there is discounts allowed as well. And we don't have any discounts allowed in this question. Okay, so the provision for bad debts and the bad debts comes out of the sales to get the net sales. From that, we less the cost of sales. We start with the inventory, and we have the purchases, and we do with the purchases similar to what we did with the sales. We take off the discounts received and they add on the carriage and wads. Okay, if there's any returns itself, we will also take off that. And we get the net purchases here. Add that to the cost of sales, sorry, to the opening inventory, and we get this figure here. From that, we minus the closing inventory, and we get the cost of sales. Take the cost of sales from the net sales, and we get our gross operating income. Okay, so this income is only from operations, from trading, right? Now, the question asks for multiple step, right? That's why we have to show all these details. Another way of doing it, we could have done this section, the cost of sales, in our workings, and take this figure here and minus it from the net sales and get gross operating income. We would still be doing a multiple step income statement. Subscribe, like, comment. Here we have a gross operating income from the previous section of 634,201, and then we have the operating expenses. These are all the expenses from the trial balance that did not need any changing at first. We put them in first, and then we have our depreciation on equipment and our insurance of 13,000, right? These are from our workings, giving us total operating expenses of 612,084. We take away that from the gross operating income and we get the net operating income. Then we have some other income of 3,710. You can see the figure in the trial balance again. Net income. After you take the 3,710 from the operating income, you get your net income. From that, you have to take off your financial expenses, which is the bond interest. We don't have any other loan interest. We didn't have a figure for the note payable, remember that? But we have the organization cost amortized. Since this is an intangible asset, what we do is we amortize it. We cannot depreciate it. Okay. We add these two together, we get 20,260, and we take that from our net income, and we get the net income before tax of 5,567. 1/3 or 3/3% of that is 1856. we minus from the net income and we will get a net income after tax. Up next, we will look at the entire income statement. We're looking at the entire income statement now. We must make sure that we have the headings in 3 lines. We must answer the question who, what, when. Whose income statement it is? Kmart Limited. What statement it is? The income statement. And when? For the year ended 31st December. We must make sure also that the sales and returns and allowances comes out of the sales, does not come out of any other figure. Similarly for the purchases, the returns and the discounts and the freight must be added on or minus from the purchases. We cannot take them from the opening stock. And we get the net purchases here. This is added to that. Okay, after we get the operating income, we can add the other income to the operating income as well. That's another option. Okay, the operating expenses, general, selling, and administration, and we have salaries separately, depreciation, equipment, and insurance. Okay, those are the operating expenses, the bond interest, and the amortization of the organization costs comes in the financial section, and after that we get our net income before tax. We have to minus the 1/3 of tax from, and then we get 3,711 as our net income after tax. Now you can take this as a format for the IAS. There are many formats in the IAS itself. This is a simple format for multiple steps, and you can use this. Next, we have Part B, Kmart Limited Statement of Retained Earnings. Notice again, it's a statement of retained earnings, it's not a statement of equity. Retained earnings is one account only in the equity, and it is at a particular date. Okay, we start with the balance from the trial balance of 110,000. We add the net income for the year, and we get 3,711 and 15,711. From that, we minus the items that would cause the account to decrease: the preference dividend, 9,600, and the ordinary dividend, which we calculated in the workings. And we will get a balance at the end of the year of 74,111. Notice all we have to do with the statement of retained earnings is we have to add on those items that cause the account to increase and minus those items that cause the account to decrease. So, and we'll get a balance at the end of the year. It works just like any other account. And sometimes you have other items like transfer to reserves and so on that causes the account to decrease, and there may be other items that cause it to increase, but usually the only item that causes it to increase is the net income for the year. Subscribe, like, comment. 3 friends, Kari, Kwame, and Kofi, form a partnership to operate a nightclub, Seventh Heaven, with Kari investing 200,000, Kwame 160,000, and Kofi 100,000. They agree to share the net income as follows: salary allowances 160,000 to Kari, 100,000 to Kwame, and 100,000 to Kofi. Interest allowances 12% on opening capital account balances of each partner. Any partnership income in excess of the amount required to cover the interest and salaries is to be divided 60% to Quarry, 20% to Kwame, and 20% to Kofi. The partnership income for the first year of operations ended 31st December 2012 amounted to 741,000. Show how the income of 741,000 would be divided among the three partners. Show clearly the amount of interest, salaries, and the residual amount divided. 17 marks. The part C, the answer, we could do the answer in three columns like this, one for Kari, one for Kwame, and one for Kofi. And a total column here that controls it to tell us what it balances back to the 741,000. The first we will give them their salary, 160,000, 100,000, and 100,000, giving us a total of $360,000. Then we give them their interest on capital. Kari would be 12% of 200,000, which would be 24,000. Kwame 19,200 and Kofi 12,000, and we get a total of 55,200. When we add those on and add the gross, we come up to 415,000. Okay, which leaves 325 again, and the profit to be shared among them in the ratios. When we share it in the ratio, Kari will get 195, 480, Kwame 65, 160, and 65, 160. Notice here that the amount we are sharing is 325, 800, not the entire thing here. Okay, it's the amount remaining after we have given them interest and salary to the total of 415,200. Subscribe, like, comment. We begin by reading what is required first. Part A. Prepare a statement of cash flows for the year ended 31st December 2011 in accordance with IAS 7, IFRS for SME Section 7, indicating clearly cash flows from operating activities, from investing activities, and financing activities. Use the indirect method. That is 20 marks. Okay, we take a look at the data provided, and I will then give you an idea of how you should proceed in doing the cash flow statement. The management of Fabric Smart Chemical Limited would like to assess the cash generating ability of the company in order to make plans for the acquisition of new equipment. The income statement is currently showing a reasonable net income. However, she does not think it is prudent to base decisions of this nature only on information from this source. The information below was extracted from the company's books, and we have here the balance sheet. Okay, and in the next slide we have the income statement. I'll show you in a few minutes. Okay, and now basically what happens is your income statement shows your profitability. That's how profitable. So having a reasonable net income like Fabric Smart Limited does not necessarily means you are generating enough cash so you can make purchases of new equipment. Okay, and the balance sheet simply shows your financial position at a particular point in time, and those dates that we have at the top. So the statement that really shows you whether you are generating enough cash is the cash flow statement. And if you want to find out if you have enough cash to acquire new equipment, if you have enough cash passing through your business, then what you have to do is look at your cash flow statement and assess that situation. Now, basically, what the cash flow statement will do, it would show you how you got from this position, the movements in the cash from $26,050 to $51,920 within the year. Okay, some of the cash would have come from your operations, some would have come from your investing activities, and some would have come from your financing activities, and some of them would have also gone out in those three areas as well. So, what the cash flow statement will do is it show us how that happened. Now, let's look at the other piece of data provided. Right, we have here the income statement showing us the net income and the statement of retained earnings for the year ended 31st December 2011. This shows us the retained earnings movement, what was done with the net income. Okay, so from these bit of data, we are going to compute the cash flows statement. So stay tuned for the workings coming up. We'll start with the workings. First, we have to reconcile the net income. The figure we are interested in is the net income before interest and taxes. What we are given here on the income statement is the net income after the interest and taxes have been taken out here. So the reason for this is we want to show these figures as being paid in the the cash flow statement. So we have to adjust the net income backward. Okay, so we take this figure and we add back the interest on expense and tax expense, and we'll get the interest before the income before interest and taxes of 133,470. Next, we will look at the changes in the working capital. The working capital is made up of the current assets and the current liabilities. And the first one we look at is the accounts receivable. And we see the changes here, which involve a movement of cash, is an increase of 20,680. Okay, increase in AR is the increases in current assets usually means there has been a decrease in cash or an outflow of cash. Next, we have the merchandise inventory. Again, we see it increase from 401 to 431, so that would be an outflow of cash of 30,000. The same with the, sorry, not the store supplies. This time it goes the other direction. It changes from 790 to 520. That is a decrease of $270, giving us a cash inflow of 207. Then we have the prepaid electricity, which remain the same, and then the prepaid rent has a increase of $300, so that would give us an outflow of 300. We move next to the current liabilities, the other component of the working capital, and we see the accounts payable decrease by 13,900. So that would be a decrease in cash, because it would mean that we are paying some of our accounts payable. And we'll look at the note payable separate, because that is not an item of working capital. The other one is the insurance payable, sorry, and it decreased from 1990 to 1040, a decrease of 950. So it means we would have paid some, that's an outflow of cash. The other item is the interest payable, which we handle separately, since that is not an operating expense, so it does not comes into the working capital. We take the interest balance at the beginning of the year, and that is interest payable 1160, and we add on the amount from the profit and loss account here, 790 with the 1950, and the balance carried down is 120. Minus that, we get the amount paid, which is equal to 1850. Now you can use the same formula to calculate the amount of cash that was paid for any item. And then we do the same thing with the taxes, and we get 44,290. Okay, so balance brought down with 10,460 from here, and then we get the profit and loss account 45,110, and we minus the balance carried down 11,280, and we will get 44,290 as being paid. Now all these figures, we put them together to get the net cash flow from operating activities or operations. Statement. Here we have Fabric Smart Jamaica Limited statement of cash flows for the year ended. We start with the net income before interest and taxes of 133,470, and to that we add back the depreciation, and we minus the gain on the sale of the asset. Okay, now the reason for doing this is because depreciation and gain on sale of asset or loss on the sale of asset, they do not involve a flow of cash. and they went into calculating this figure. So we have to add them back to get the cash flows. So this and this would give us the cash flow from the net income that would adjust it. Increase in accounts receivable, all the items that we just calculated. An increase in accounts receivable represents an outflow of cash. This section is the working capital, the changes in the working capital where cash is involved. Increase in inventory means we would have paid money out to get the increase in inventory. And similarly with the accounts receivable, we've taken the inventory from here, sold it on credit, and not got any cash for it. So the decrease in the store supplies is an inflow. An increase in prepaid rent, that means we paid more rent than we supposed to. It's an outflow of cash. Decrease in accounts payable, it's another outflow of cash. It means we paid some of our accounts payable. Same applies to the insurance payable. So when we add this column down, we will get a total outflow of cash of 65,580, and we can add these down now, and there is an inflow of cash of 87,680. To that we add back the taxes that was paid. Sorry, that should be, we take out the taxes that was paid because that's an outflow of cash, 44,290, and then the interest paid 1830. We just calculated that. You can flip back in the video and look at it, and that will give us our cash flows from operating activities, which is one of the figures that they ask us to calculate. If we look at the investing activities, the sale of the fixed assets given in the notes to the income statement is 12,230. We received for the sale of it, and the dividends paid in the statement of retained earnings, which is 60,000. And when we put the two together, we'll get cash outflows totaling 47,770. You should verify these figures by looking back at the amounts in the question. So we look at the financing activities. First is the payment of the note. The note payable, the balance brought down from the balance sheet. 2010 was 59,640. You should verify that. And balance carried down in 2011 is 51,720. It means we have made a cash payment of 27,920. The common stock sold is 12,000 by $5 is 60,000. So that is an inflow of cash, and the payment of notes an outflow of cash, giving you a total of cash flows from financing activity being 32,080. Our increase in cash when we put all three of them together is 25,870. We add that to the balance at the beginning of the year of 26,050, and we will get the balance at the end of the year. Now these two figures here should balance back to the balance sheet, the comparative balance sheet balances. We can now put all the figures together here. We can see the cash flows from operating activities, from investing activities, from financing activities, and the reconciliation. We should note that this balance here would equal the balance of cash at this date in our balance sheet. Part B. For the year ended 31st December 2011, calculate the following ratios for Fabric Smart Jamaica Limited and interpret your answers. 1. The current ratio. 2. Quick ratio. 3. Debt to total assets. 4. Debt to equity. And 5. Net income to total assets. Current ratio. Current assets to current liabilities. In this ratio, the current liabilities is always 1. So we add up the current assets on the balance sheet and we get 580, 330, and the current liabilities is 49, 840. We said the current ratio, the liabilities is always 1. So in order to get the figure for this side, we have to divide it, the assets by 49, 840, and we'll get 11.6. Now this ratio shows how many times the current assets covers the current liabilities. Okay, or how many times the current assets could pay off the current liabilities. A good ratio is 2 to 1. In fact, that's a benchmark ratio, and Fabric meets this quite easily. They are at 11.6 to 1, but this ratio is probably a bit too high, and they just might have too much current assets in their business. Next, we look at the quick ratio, and this is a stricter measure of the liquidity than the current ratio, in that it leaves out the inventory from the current assets and then check to see whether it could still cover the current liabilities. So we have the 580,330 for current assets minus the 431,000 for inventory, and again the current liabilities stay the same. So when we divide this, we will get 3 to 1 this time. Okay, so it shows how many times the current assets covers the current liabilities without including the stock. Okay, that's 1.5 to 1 is considered good. Fabric Smart meets this easily, but they may still be too liquid because they're about twice the amount of the benchmark. That is, there's too much cash in their business. So we are going to look at the debt to total assets. The total debt is 81,560 from the balance sheet, and the total assets is 742,610. And when we record out the percentage, it works out to 11%. So this shows the proportion of borrowing or debt to the total assets. And what it means is that 11% of Fabric Smart assets comes from borrowing, and that's a very low percentage, and maybe they can do some more borrowing. For debt to equity. Again, the debt is the same, 81,560. The equity is different from the total assets. The equity is the common shares and the reserves. So that is 661,050, and as a percentage, it's 12.3%. This shows the proportion of debt or borrowing to the capital. It is what you call a gearing ratio. Less than 50% is low geared, meaning the shareholders are providing more funds than the creditors. More than 50% is high gearing, meaning the creditors are providing more of the funding. The Fabric Smart is low geared at 12.3%. That means the creditors are providing very little funding for Fabric Smart. Net income to total assets. The net income is 87,570, and to the total assets it's 742,610, 11.8%. This shows how efficient Fabric Smart was in utilizing its total assets. They had a return of 11.8% on their assets. As to whether this is high or low, we can't really tell because we don't have any figures for the industry or another business. Whether it's increasing or decreasing, we can't comment on that either because we don't have another year's financial statement. 20. Welcome to another Mr. James accounting tutorial. This time we are looking at accounting unit